Hey everyone, welcome back to Corporate Decoder, the place where we decipher corporate filings so you don't have to. Today, we're diving into Grainger's proxy statement. Get ready for a peek into board decisions, executive pay, and a debate about voting rights, because this one has it all. It's like a corporate governance soap opera, but with more spreadsheets. First, let's cover what Grainger is all about. Grainger isn't your everyday corner store. They're a big player in the maintenance, repair, and operating, or MRO, products and services world, basically keeping factories and businesses running. They sell everything from safety gloves to power tools, and they do it on a massive scale, with nearly $17.2 billion in sales just last year. So what's on the agenda for Grainger's annual meeting? Well, the first item is picking the people who will be running the show, the board of directors. There are 12 nominees up for election this year. And speaking of the board, one thing that stands out is independence. Almost everyone on the board, except the CEO, is considered independent, meaning they don't have any significant ties to the company that could cloud their judgment. The board takes its role seriously. They're not just rubber stamping decisions, they're actively involved in shaping Grainger's strategy, overseeing risk management, and even making sure the company's culture aligns with its goals. The board also makes sure there are no shady deals going on with people connected to the company. You want to make sure directors are acting in the company's best interest and not their own, and there's a policy in place to review any transactions that might raise a conflict of interest. Now let's talk about a change that Grainger is proposing. They want to get rid of something called cumulative voting. Basically, cumulative voting allows shareholders to concentrate their votes on a single director nominee, potentially giving minority shareholders more power to elect someone to the board. Grainger argues that this system is outdated and could lead to board dysfunction. They want to switch to a one-share, one-vote system, which is more common. The company states that it is all about majority rule, and they argue this change would prevent a small group of shareholders from hijacking a board seat. Whether shareholders agree is another matter, and something we will explore later in our analysis. Now, let's dive into who these board nominees actually are. It is important to understand the qualifications and experience of each nominee as we prepare for a board that may be elected with majority rule. These aren't just random names, they're seasoned executives with expertise in everything from technology and finance to supply chain management and marketing. Each one brings something to the table, whether it's experience running a major company or deep knowledge of the global marketplace. For example, Rodney Adkins, who has been on the board since 2014, brings a wealth of knowledge from his time at IBM, where he managed everything from corporate strategy to global supply chains. George Davis, who joined the board more recently, is a finance guru, having served as CFO for major tech companies like Intel and Qualcomm. Then there's D.G. Macpherson, who is both chairman and CEO, bringing over 17 years of experience with Grainger. The report also lists various other leaders and their qualifications. The board also has a few key committees, each with specific responsibilities. There's the Audit Committee, which keeps an eye on the company's finances, the Board Affairs and Nominating Committee, which handles governance and nominations, and the Compensation Committee, which decides how much the executives get paid. Let's talk about money now, shall we? How much are Grainger's directors making, and how does that compare to what the company is achieving? The company aims to compensate its non-employee directors at a level that approximates median market practice. Each non-employee director gets a cash retainer of $115,000, plus a stock grant worth $175,000. And if you're a committee chair or the lead director, you get an extra cash payment. For example, Stuart Levenick, who is the lead director, made over $340,000 in 2024. Then there's executive compensation. In simple terms, Grainger wants to pay its top executives in a way that rewards them for good performance and aligns their interests with those of the shareholders. A large part of the executives' compensation is in the form of long-term incentives, that is, stock and performance-based bonuses, which means they only get paid if the company does well over time. There's a whole section called Compensation Discussion and Analysis, dedicated to explaining how they decide how much to pay the top dogs, so let's dig in. The Compensation Committee also reviews everything from base salaries and annual bonuses to stock options and other perks to make sure their compensation plans are competitive. Speaking of risk, the company analyzes its compensation programs to make sure they aren't encouraging executives to take unnecessary risks. Plus, there's a clawback policy in place, which means the company can take back bonuses if executives engage in misconduct or if the company's financial results are inaccurate. This year, the numbers for the 5 named executive officers are: their base salary ranged from $605,000 up to $1,137,568 for the CEO. On top of the base, there were stock awards of just over $800,000 up to $7,800,000 for the CEO. On top of this, there were all other incentives which added up to just under $2 million for the CEO and smaller amounts for the other executives. For example, for 2024, Grainger paid its CEO around $10.8 million in total compensation, while the average of the non-CEO named executives was around $3 million. Grainger also includes a CEO pay ratio, which compares the CEO's pay to the median employee's pay. For 2024, the CEO's pay was 163 times that of the median employee, so for every dollar that their median worker made, their CEO made $163. The section about executives ends with all sorts of detailed explanations about how payments work in the event of job loss and retirement. Finally, there's the usual legal disclaimer, reminding everyone that these are just estimates and predictions, and the future could look very different. The world is always changing, so it makes sense to take these with a grain of salt. They cite a whole host of potential problems, from rising costs to competition to supply chain issues, even climate change, so all the regular risk factors. Okay, so what does this all mean? Let's step back and take a look at the big picture. Grainger seems to be a pretty well-run company with a strong focus on governance and a clear strategy. The board is active and engaged, and the compensation programs are designed to reward performance and align executives with shareholders. This report sounds pretty boring, with many of the checks and balances that you'd expect and really not too much out of the ordinary. A potential area of contention is the proposal to eliminate cumulative voting. While Grainger argues that it's a matter of good governance, some shareholders might see it as an attempt to consolidate power and reduce their influence. Financially, Grainger appears to be on solid ground, with strong revenue growth and a healthy return on invested capital. However, like any company, they face risks and challenges, including competition, economic uncertainty, and the ever-present threat of cyber attacks. Overall, Grainger seems to be a company that's committed to creating value for its shareholders. But like any investment, it's important to do your own research and make sure it aligns with your individual goals and risk tolerance. Thanks for watching. If you found this helpful, be sure to like, comment, and subscribe.